So let's say you have $4 million business. You and your partner own it 50-50. He passes away unexpectedly. His widow now owns half of your company, but she doesn't want to run it. She wants her money out. So what do you do now? Today I'm going to show you the 3 ways to fund a buy and sell agreement: cash, borrowing, and life insurance, and the math that goes with it. And you'll find that life insurance is roughly 74% less expensive than the other methods we're going to talk about. If you don't have a plan, the answer is usually one of 3 things: a fire sale, the business gets sold. Often a stranger just arises with cash to buy it. A forced partnership, you end up in a business with someone who never really wanted to be there. Or the bank calls the loans, lenders get nervous about the ownership uncertainty, and they tighten up the noose. None of those are good, and every single one of them is avoidable. Now, I'm guessing you've heard of a buy and sell agreement, and you might even have one. So before you say we've got that covered, let me tell you what most owners don't realize. The buy and sell agreement is just a piece of paper that says what happens at a partner's death. They leave, they get divorced, a disability, or just wanting out. It names the price, it names the terms. But here's the thing, the agreement is the what. It's nothing about the how. How does the money actually get from the surviving owner's pocket to the widow's hands? Because that's the part that breaks the deal. I've seen it happen more than I can count. The agreement was perfect, the funding was there, and the whole thing collapsed. Or the business got sold to a stranger to pay the estate. So today we're going to talk about the 3 ways to fund a buy and sell: cash, borrowing, and life insurance. And I'm going to show you the math on which one of them is dramatically cheaper than the other. So let's talk about the first way owners try to fund it: cash. Listen, we'll just save up, pay the widow ourselves over time. Sounds reasonable. But let's run the numbers on our $4 million business. You're 50-50, so your buyout is $2 million. Let's say your business generates $400,000 a year in distributable cash, and you split it. That's $200,000 each. So to save $2 million in cash, you would need to set aside your entire share of the profits for 10 years, every dollar. No raises, no reinvestment, no new equipment, no growth, just parked money doing nothing in case your partner dies. And here's the uncomfortable question: what if the event happened in year 2? Then you're $200,000 into $2 million obligation. And what happens to your cash flow in the meantime? Your business is now running on fumes because all the profit is sitting in a saving account instead of working. The reality is cash funding only works in one scenario: if you never need it. The moment you do, it's never enough. That's not a plan, that's a gamble. So option 2, borrow the money. So what a lot of owners assume they'll do: the bank or the widow accepts a note payable over time. Not much thought. But now, a note can work, but let's look at what actually costs. On our $2 million buyout, financing over 10 years at 7%, that's about $28,000 a month. Over the life of the note, you're going to be roughly paying $800,000 in interest, basically money that goes to the bank instead of staying into your business. But there's a bigger problem than the interest. The bank's money comes with strings. You need personal guarantees. The business becomes collateral, and the worst part, the note is due even if the business hits a downturn, a recession. It doesn't pause your payment. Customers leaving, don't pause your payment either. And one more thing, the widow has no reason to accept a slow note when the agreement says she's entitled to a value now. Notes get renegotiated, that's when the disputes happen. And the business you're trying to protect gets dragged into court. So cash starves the business and debt mortgages it, which brings us to the third option. So let's talk about the third option. The one I believe is the least expensive way of paying for transfer costs, life insurance. Here's the idea, and it's brutally simple. You take out a policy on your partner's life. The business, or you personally, depending on how it's structured, owns the policy and pays the premium. When the partner dies, death benefits arrive tax-free within weeks. That's your buyout money. The widow gets paid in full, the business keeps running, and nobody has to sell the business or beg the bank. Now, let me show you the cost comparison because that is where it gets pretty interesting. On our $4 million, $2 million buyout, for a healthy partner in his 50s, $2 million death benefits roughly costs about $20,000 to $40,000 a year in premium, depending on the structure. Now, let's compare that to the alternatives. Right here on the screen, cash funding means setting aside $200,000 a year of the profit. Borrowing means $28,000 a month plus $800,000 interest. And the insurance approach, you fund the premium and you do it with pre-tax business dollars. Here's the number I use with my clients, and it always gets their attention. The trust-owned or LLC-owned life insurance approach is roughly 74% less expensive than the next best option. 74%. And unlike the cash plan, the coverage is there in full from day one, not after 10 years of savings. So now that we've established why insurance is a smart way, let's talk about how you structure it. Because there are two classic ways, and the mistake here is expensive. The first way is a cross-purchase agreement. You own the policy on your partner's life, they own it on you. When one of you die, the survivor receives the death benefit and buys the deceased shares directly. Simple, clean. The second is an entity purchase, sometimes called a stock redemption. The business itself owns the policies and buys back the shares of the deceased partner's estate. Very simple. A couple years ago, we had something called the Connolly case that changed how they treated, for accounting purposes and value purposes, a stock redemption. I'm not going to get into it in this video. I do have other videos to share with you about it. Now, which one is right for you depends on the situation. Corporate ownership can be more cost effective in some structures, and it's easier to administer with more than two partners. So if you have three partners, you need 6 policies under a cross purchase. With a stock redemption, you only need the 3. But if you're C corporation, there could be some alternative minimum tax issues, and if you're an S corporation, the ownership and basic questions need real attention. So you got to pay attention there. In regards to Colony, LLCs, partnerships, trusts, and insurance LLCs work very well with limited policies doing the same thing as a stock redemption, just as a footnote. This is where the nuance lives, and exactly why I tell owners don't draft from a template you found online. The structured decision has tax consequences that follow your family for generations. So if you really want to do it the right way, there's more of an advanced layer of information to mention, and that's the one that's going to save you the most amount of money in the long run. And my suggestion is, instead of a stock redemption agreement, set the insurance up through the LLC owned approach for a couple of reasons. One, to keep the proceeds out of the estate, an expedition of the proceeds to the widow, and some other tax issues that in the past trust owning life insurance for buy and sell agreement caused. Now, there's another tool that businesses with 5 to 50 employees should consider, and that's called key man insurance. And the difference between key man insurance and buy and sell policy is that the key man insurance protects the business itself from losing key people in your middle management, which usually are the most valuable parts of your value drivers and builds your business. And I bring that up because I believe this is a very important part of ensuring elements of your company to maximize the growth of your company. So let me leave you with mistakes that I see owners make so you don't make them. Mistake number 1, buying term insurance that expires. Buy and sell needs are permanent. You don't get to predict the year. Permanent coverage is the honest answer because it'll be there when the event happens. Mistake number 2, the policy's ownership is wrong. If the person who owns the policy and the person who owns the buyout aren't the same, the death benefits can create a tax problem and defeat the whole purpose. Number 3, not updating the valuation, very important. The agreement says $4 million, but the business is now worth $9 million. That's not a plan anymore, it's a time bomb. And mistake number 4, assuming your partner is insurable. If there's a health issue, you want to know it now, not after it's too late. Get the coverage in place while you can. So there are a couple of things that I'd like to cover before I leave, and that's look for my report that is below. I have a very good report on the buy and sell agreement and a guide. 2, check out the last version of this series, which is the deadlock series. What happens if you have a 50-50 partner and he wants out? Didn't die, but he wants out now. What do you do? And if you like the video, certainly like it, subscribe. That helps us out. And please leave any comments. I'd love to hear your comments on the video and the information. So here's what I would want you to do this week. Pull out your buy and sell agreement and see if it's actually funded. 2, get an illustration on your partner and yourself. Just the numbers, no commitment, just look at the numbers. Have the conversation with your partner. It's awkward, I know, but the alternative is the conversation you would have with the widow, the fire sale, the bank is a lot more awkward. Picture the person that has a lot of land or a building and they have to transfer. They have to sell it. That's a fire sale waiting to happen. Don't let that be your business. If this was helpful, give me a like, subscribe, and if you have any questions, drop them in the comments. I read every single one of them. Also, if you are in a situation that you need a second opinion, schedule time with me. I'd love to talk to you about it and discuss it on the phone. Also, check out the video using the shotgun provision that I had mentioned earlier before. This is a very good video about what happens if your partner wants to leave, they don't die. And I have a great download down there in the description. So thanks again for taking the time. I appreciate it.